More robots than Boston Dynamics, more ad dollars than Snapchat, and a cloud business big enough to host your favorite LLM's midlife crisis. This is Amazon, and today we're figuring out whether the hype is alpha or just everyone's rotating into a new Mag 7 narrative because they're tired of saying Nvidia. Let's be honest, YouTube finance has turned into the Mag 7 Olympics. Nvidia's pretty much already won gold, and now creators are lifting Amazon into the spotlight like it's the next chosen one. But if you're running a focused portfolio, 10, maybe 15 positions max, you've got to ask, does Amazon really earn a slot? What edge does it give you that Nvidia or Meta doesn't already? Because the beta's basically the same. And if you're already exposed to tech and AI infrastructure, doubling down on the king of GPUs might be the cleaner play. So this isn't just another hype piece. We're breaking down Amazon's actual drivers, from robotics to retail margins, AWS to ad revenue, to figure out whether this is just momentum or if there's real alpha hiding underneath. Let's talk about the real engine behind most stock moves in this cycle: narrative. Amazon has found its story again. It's no longer just an e-commerce dinosaur with too many Prime shows. It's been reborn. Now it's the AI infrastructure play, the warehouse automation king, the margins expansion turnaround. Pick your angle, it's got one. The logic is simple. If Nvidia is the GPU monopoly, Amazon is the company quietly building the rails that runs everything on top of it: cloud compute, logistics infrastructure, AI inference. And that story has legs, because in a market where half the performance is just getting in before the narrative hits critical mass, Amazon looks safe and scalable. Now let's be clear, narrative isn't meaningless. Narrative front runs fundamentals. You get multiples expansion before earnings catch up. So if you believe the market's just waking up to Amazon's margin shift, cloud upside, and ad flywheel, then you want to be long before it prints. But narrative without numbers, that's just storytelling, right? So next, we're pulling apart the actual levers, where Amazon's margins are moving and what AWS is doing under the hood, and whether this is hype or something more serious. So let's start with the obvious. Amazon's figured out how to scale without hiring another 600,000 warehouse workers. They've now got over 750,000 robots working in fulfillment. That's more than the US military has humans. And they aren't just gimmicks. Their newest fulfillment centers use 10x more robots than the previous generation and deliver up to 25% lower peak fulfillment costs. Translation: these robots aren't just cool, they're margin expansions you can model. North American retail margins hit 6.1% last quarter. That's the highest in years, off the back of automation, regionalized logistics, and fewer warm bodies needing to push carts. Turns out the easiest way to win a labor dispute is to replace the entire labor force with lithium-ion batteries and a firmware update. And it scales. These aren't just pilot projects. Over 75% of Amazon orders are now touched by robots. That's not trailing the future. They're already shipping it. So the question is, what's that worth? If every 1% of margin in retail equals billion in EBIT, this automation shift isn't just operational, it's financial leverage. And it's very real. Amazon retail gets all the headlines, but AWS is actually the reason the business has a pulse. In 2024, AWS made up just 17% of Amazon's revenues, but delivered nearly 60% of total operating income. This isn't just a side hustle. This is the operating system for the internet. And it's the only reason Amazon can afford to 2-day ship your phone charger and oat milk at scale. Now, growth slowed in 2023. Too many enterprise clients were trimming fat. But here's the twist. Even with margin pressure, AWS still throws off 30% plus EBIT margins and is plowing capital into AI infrastructure like it's training for the GPU decathlon. Why? Because inference workloads are exploding. Every AI startup that doesn't want to build a data center ends up renting compute from AWS. Unlike the GPU crowd, Amazon's making its own silicon, Trainium 2, Inferentia chips, offering 30 to 40% better price performance for AI inference. And here's the part not many people were talking about: data gravity. AWS already holds the workload. That gives them pricing power, cross-sell leverage, and retention that AI competitors would kill for. So while YouTube is distracted by shiny AI tokens and LLM logos, AWS is becoming the toll booth for actual deployment. And so if you believe AI workloads will 10x this decade, AWS might quietly be the real picks and shovels play under your nose. Everyone talks about Amazon as retail or AWS, but really the quiet monster here is advertising, and it's arguably the most profitable part of the entire company. This segment has gone from zero to nearly 70 billion in annual run rates, faster than TikTok grew its user base. And margins? While they don't break it out, smart money pegs this at 50% plus operating margins. You search for socks, Amazon charges 8 sellers to show you the exact same pair of socks, just slightly different fonts and packaging. This isn't advertising, it's rent collecting with a UI. And because over 60% of sales are from third-party vendors, Amazon just sits back and monetizes the volume without taking any inventory risk. So while AWS funds the CapEx, ads quietly boosts Amazon's margins profile without needing another warehouse, another robot, or another lawsuit. This is the sleeper thesis. Ads aren't a side hustle. They're the second flywheel, and they're growing faster than retail itself. And retail used to be Amazon's problem child. High revenues, razor-thin margins, and endless CapEx. But now, it's kind of working. North America, operating margins are now above 6%. The highest in years. International's profitable now, which is impressive. And this isn't just seasonal noise. It's the results of the robot margin engine we talked about earlier, plus regionalized logistics, fewer miles per package, and automation doing most of the grunt work. This is how you get scale without scaling headcount. No new warehouses, no new labor disputes, just more throughput per square foot. It's not sexy, it's not exponential, but when you're doing 500 plus billion in retail revenue, every few points of margin expansion equal billions in incremental EBIT. Retail's never going to be the high growth driver here, but it doesn't need to be. If it keeps compounding quietly in the background while AWS and ads do the heavy lifting, that's exactly what makes the whole Amazon flywheel work. And here's the real question. If you own Nvidia, why also own Amazon? The beta is similar, the conviction levels on YouTube are identical, but the actual business dynamics are wildly different. Nvidia is a razor, Amazon is a toolbox. Nvidia is monopoly pricing on a must-have component. Amazon is diversified margin stacking, scaled through ops. Nvidia is faster, cleaner, easier to understand, but that also means it's priced for perfection. Amazon's value isn't exploding revenue growth. It's in margin expansion, segment leverage, and the quiet compounding from 3 engines firing at once. You break it out. AWS could be worth 700 to 900 billion alone. Ads, another 3 to 400 billion. That leaves retail basically as a free option in the valuation. That's not obvious in the screen, but it matters if you're thinking in layers. If you want maximum acceleration, you're overweight Nvidia. But if you want something that's still high growth with margins expansion and multiple re-rate potential, Amazon isn't just a safer pick. It might be the better risk-adjusted one. So here's the key. Amazon's not under-owned, it's not under-followed, but it might still be unappreciated. Consensus has Amazon nearly doubling earnings from here by 2026 and tripling them since 2023. But what if even that's light? Here's what I think the market isn't fully pricing in yet. The first is retail margin expansion isn't quite yet done. If robots and logistic tweaks got us to 6% in North America, what does 8% look like? At Amazon's scale, that's billions in EBIT most people are treating as flat. The second is ads might become the most profitable part of the business. Everyone's talking about AWS, but ads is growing faster with better margins and zero CapEx. If that segment gets re-rated like a platform business, valuation multiples can change fast. The third is AWS is building the AI infrastructure layer, not just selling cloud. Between Bedrock, Trainium, and full stack deployment tools, AWS might become the deployment endpoint for generative AI. If that happens, the margins and retention explode. None of these are moonshots. They're just second-order effects of things already in motion. And that's where information alpha comes from. Not finding something hidden, but seeing something that's obvious before it's consensus. Amazon might not be a 5x, but it doesn't need to be. If these margin drivers keep inflecting, it can still double, with less volatility and more diversification than almost anything else in big tech. So what's the catch? Because if the story is this good, the risk isn't what you know, it's what you're not thinking about. So the first is antitrust and regulation. The FTC's been circling Amazon like a full of Prime subscriptions. There's a real case brewing here. And if they win, Amazon could be forced to unwind key marketplace practices. Ironically, a break might actually unlock value, an AWS IPO, anyone? But headline risk equals discount multiple under clarity. The second is AWS margin compression. Everyone loves the cloud until margins slide. AWS actually dropped from 40% to low 30s as AI capex ramped. If that turns structural, it puts pressure on Amazon's cash flow narrative. The third is international drag. Outside the US, profitability is a mixed bag. India's hyper-competitive, Europe has regulatory headwind, and you're one EU vote away from a forced data silo. The fourth is that robots don't strike yet. Labor risk isn't gone, just shifted. Warehouse injuries, union momentum, and workforce PR could all swing sentiment fast, especially in an election year. None of these risks are catastrophic, but they cap multiples expansion, and they force execution to stay perfect. Amazon's priced for compounder status, not margin disappointment. So if you're long, you're betting the machine keeps grinding, margins keep widening, and regulators don't slam on the brakes. No moonshot risk, but definitely not autopilot either. If this shifted your thinking about Amazon, please hit subscribe. I'm breaking down real equity stories, not just chasing chart patterns. So if you want analysis that actually respects your time, please stick around and subscribe. Drop your Amazon versus Nvidia take in the comments, and if there's a stock you think deserves the next deep dive, you know what to do. Thank you so much for your time, and I'll see you in the next one.